we are not going to be coming back out to school? Here, online classes, please. Make sure and join all your online classes. It takes a lot for us to put out this information for you in a format that you can receive and hopefully understand. So this lesson today, we will continue our online classes. Join us as we post the ledgers in terms of the accruals and prepayments, the expense and revenue accounts. So, in the accounting cycle, we have been doing the adjusting entries, starting with the accruals and the prepayments, and the 4 types of accruals and prepayments: the prepaid expenses, prepaid revenue, accrued expenses, and accrued revenue. Now, these 4 types are assets and liabilities, with the prepaid expenses and accrued revenue being the assets, and the accrued expenses and prepaid revenue being the liability. Just like all other assets and liabilities and the other categories, they are supposed to be recorded according to the accounting cycle, which means that they really do have to be journalized and posted to ledgers. So today we are not going to be doing the journalizing, but we are, however, going to be posting to the ledger accounts, which would be the T accounts. However, it should be noted that for CSEC, even though the 4 types are assets and liabilities, we do not post to their asset and liability accounts. We would learn instead that they are recorded as the brought down figures and carried down figures in the expense and revenue accounts. So the nominal accounts instead of the real accounts being the assets and the liability. So that is what we are going to learn how to do, the format for the expenses and the revenue as it pertains to the accruals and prepayments. And we are also going to become a little bit more clear in terms of the opening balances and the closing balances. Just in case you were not that clear, we will try to clear it up even further for you. So that's the lesson for today. So if you would remember, a ledger account is a separate page in a ledger book which records increases and decreases in each balance sheet and income statement item. That would be ALICE in terms of assets, liabilities, income, capital, and expenditure. So the ledger accounts are known as the T accounts, and that's because they look like a T with a debit side and a credit side. And those are 2 very, very important accounting terms. So you have your T accounts, and you should know that each side, the debit and the credit, is divided into 3 to 4 columns depending on whether you also have the folio column. So date details debit, definitely, and then you may have the folio. And then the next side, the credit side, it's the same thing, date, detail, credit, and you may have the folio. The folio just tells you which journal the information came from, right? So you have your debit and credit sides. Your debit side is always on your left, and the credit side is always on your right, depending on which side you're looking at, right? Left, right. Increases and decreases in each balance sheet and income statement item is recorded according to double entry rules. So if you remember the double entry rules, ALICE, we have it as ALICE. For the increases, assets and expenses are debited, and the liabilities, income, and capital are credited whenever there's an increase. And whenever there's a decrease, it's the opposite. But for this one, as we said before, we are not going to be recording the accruals and prepayments in their assets and liability accounts. Instead, we are going to be recording it as opening and closing balances in the expense and income account. So because of that, we are going to be only focusing on the income or revenue account and the expense account. And if you would remember, and you're seeing it right there, we're seeing it right there. If it is that you increase your expenses, you debit, and decrease you credit. And for revenue, it will be the opposite. If you're increasing your revenue, you're going to credit, and if you decrease, you're going to debit. So we're going to go into what items increase and decrease the expenses and the revenue, specifically in terms of the accruals and prepayments. So we have our expenses and revenue, which are the two accounts that we are going to be focused on. Once again, emphasizing that even though the four types are assets and liabilities, we are not going to be posting to those accounts. We are going to be posting to the expense and the revenue, starting with the expense accounts. So we're going to learn the format for the expense accounts. So a business has all these different types of transactions, like the buying and selling of inventory, for example. And because when you're operating, there are many costs and expenses that are incurred in the course of business. And we have to spend this money. We have to spend this money to operate, to use our assets, our economic resources to generate hopefully a profit at the end of the period. So expenses, an expense in accounting is the money spent or the cost incurred by a business in their effort to generate revenues. Some expenses include rent, wages and salaries, insurance, interest on loan, utilities, just to name a few. These represent the cost of doing all the business activities aimed at resulting in hopefully a profit at the end of a period. So like with any format, you always start with the name of the business, and then you would name the account, whatever the particular expense account is. Like we called out some examples of expense accounts like rent and utilities and salaries and wages and all that. So you would name the specific account, and you do the T account, and you have your debit and credit, and the expense account records all of the expenses incurred and paid for a period. That is what we use the expense account to record. Now, as we said before, according to the double entry rules, the expense account, any increase in the expenses is recorded in the debit side or on the debit side, and any decreases would be recorded on the credit side. So that is according to the double entry rules for expense accounts. Now, what transactions would constitute an increase and a decrease? So that is what we are going to go into. Now remember that the expenses incurred and paid in a period is what is recorded in the expense account. So that is what we are going to do now. We are going to record, and we're going to assume that we are now starting to operate business, and we are going to do the transactions for the first month. That is the period that we're going to use for our example, for the first month of business, right? So in terms of increasing on the debit side, what type of transactions would we perform that would increase the amount in the expense account? Every time we make a payment, on that expense, it is recorded in the cash book and in the expense account on the debit side. So during the period, every single time you make a payment, you pay that expense, you are going to record it on the debit side of your expense account. You would have the particular date that you made the payment and then the amount. If you paid by cash, the detail will be cash. If you paid by check, the detail will be bank. But every single time, emphasizing, every time you pay an expense, that is considered an increase in the expense that is recorded on the debit side of the expense account according to the double entry routes. Accrued expenses. Remember, the expense incurred and paid for a period is what is recorded, and that is what increases the expense. So expense paid, increase, enter it. An expense incurred, even though it has not been paid as yet, which is the case with the accrued expense. Accrued expenses are expenses incurred but not yet paid. It is still included in the expense incurred for that particular period. So we are doing the expense incurred for this period. Even though it has not been paid, it is still owing. It has been incurred, and therefore it is considered an increase in the expense. So it has to be recorded on the debit side. So accrued expense belongs in this period as it is incurred, and therefore it increases and has to be added to the expense paid, which is what we had been doing. Remember when we were doing the income statement and we had to calculate the expense incurred? The expense incurred was the expense paid, add the accrual. So that is what we are doing here, just like that, but we are doing it in the account this time. So you're seeing here where you're actually, this is your expense paid, that is on the debit side, and any accruals, AA, you add it. So how do you add it? You put it on the same side, which is the debit side. When you add something, you are increasing. So that is why we have been AA. We have been adding the accruals because it belongs to that period and therefore has to be added to the expense paid during that period. Then we have the credit side, and what we said for the credit side is used to record any decreases in the expense. Now, what is considered a decrease in the expense? Any prepaid expenses or expenses that have been paid in advance. Paid in advance is we have paid for the expense, but it has not been incurred as yet. So because it has not been incurred, you have to take it out of that period. It is not incurred in that period. It does not belong to that period. Even though you paid for it in that period, it does not belong there. So it decreases the amount of the actual expense for that period. So you have to put it on the credit side because it has to be decreased. So because it doesn't belong, you're subtracting it. And that is why we have been lessing prepayments. See that? When we were working out the expense incurred, we would less the prepayments from the expense paid. How do you do that in a ledger account or a T account? You put it on a different side. So what you would see here, this is your expense paid, and you add your accruals just like we had always been doing, AA, and you less your prepayments. So notice that it's on the other side where you're decreasing. So this is how you are decreasing or lessening your prepayments in your ledger accounts or your T accounts. You're doing the same thing you've always been doing when we were calculating it through the adding and lessing. This is how it is shown or seen in your ledger account or your T account. There is one more item that goes on the credit side, and that is basically your expense incurred, which is what we were talking about all the time. Your expense incurred is your expense paid. Add your accruals, which we are doing because it's on the debit side, less your prepayments, which we are doing because it's on the credit side, or the side that decreases the expense. And that expense incurred figure that you get after you have done these things, that is transferred to your income statement to calculate your net profit for that particular period. Our first month, our period. So to transfer something means to take it out, decrease it, lessen it. So this is why it's on the credit side, because at the end of the period, in order for us to calculate our profit, because expense accounts and revenue accounts are temporary accounts. They are nominal accounts. They are just there temporarily for a period, and then the amounts are transferred out to calculate your profit for that particular period. So that is what you're doing here with this. So you decrease it at the end of the period so that you can calculate your net profit for that particular period. So for your first month, you would have these possible 4 items, right? On the increase side, or the debit side, you would have every time you pay your expense, however many times you pay your expense, you put it, or you record it on the debit side of the accounts. You would put the date, the payment, whether it was cash or bank, and the amount. And you would do that during the period. At the end of the period, if there are any accrued expenses, which would be expenses incurred though not paid yet, you will also put that on the debit side, because it belongs in this particular period as expense incurred for this period. On the credit side, any prepaid expenses that do not belong in this period because they have not been incurred as yet, even though it has already been paid, you will put it on the credit side to decrease that expense for this particular period. And then when you have calculated your expense incurred, that will be transferred out of the expense account into the income statement account to calculate the net profit for this particular period. Now let's go back to the accrued expense. And the accrued expense, even though it was incurred in this period, it is still owing. So it is a liability. For the next period, it will still be owing. So what has to happen is that the accrued expense still owing at the end of this particular period has to be carried forward or carried down to the next period as a liability, because it is still owing. So it affects this period as it was incurred in this period, but the following period it still has an effect because it is still owing and has to therefore be paid in that period. So because of that, this figure would be called the carried down or the carried forward. So you may either see CD or you would see CF. It means the same thing. We use CD, and we will find out more about why we use CD after. But the carried down figure is the figure that for the ending of the period, if you still have any accruals or money or expense still owing at the end of the period, it has to be carried forward to the following period. And it's the same with your prepaid expense. Same thing with your prepaid expense. It has not been incurred in this period, but it was paid in this period. So that is why it still has to be recorded in this period. But it still has to be carried forward to the next one, because that is where it will be incurred. So you have to also put the carried down or the carried forward to show that this balance has to go to the next period. And you will just see here visually, this is the second period or the next period. And as we just said, like for your prepaid, it has been brought forward or brought down to this next period. So that is what this signifies here. You had carried down from the period or carried forward from the previous period, and this is where you would see it is now in this period. At the beginning of the period, it has to be brought into this period because it's actually going to be incurred in this particular period. So it belongs here. We have to put it here. And this is what this signifies here. And the same for the accrued. We said we had carried it down. It is therefore brought down or brought forward here. And it is shown by the BD or the BF. Now notice the sides that they are on. Even though we are not doing the prepaid expense account and the accrued expense account, and we are putting them as the brought down figures as you're seeing here for the expense in the expense account, they're still ending up on the correct side according to the double entry rules. What do I mean? Remember, prepaid expenses are current assets, and according to the double entry rules, current assets debit. And you see, it ends up on the debit side. Even though it's not its own account, it's on the debit side of the expense account. And the same thing for the accrued expense. The accrued expense is a current liability. And even though it doesn't have its own account for CSEC, in the expense account, it is still shown as a liability because it is on the credit side. So this is showing that you have an asset at the beginning of the period because the period that it was paid for previously, it is not incurred there, so it doesn't belong there. It belongs in this period as an asset. At the beginning of the period, it is our asset. So we start off with a nice asset of prepaid expenses that are going to be incurred in this period. Same thing here. In the last period, it was incurred, but it had not been paid as yet. So that means it was a liability, and we start off the next period with it as a liability. So these are our opening balances. And for any period that comes after our first period of trading, we will have opening balances or brought down figures or brought forward. So you will either see BD or BF. It's the same thing. It means the same thing. So this is just going to show us, we're just going to put it visually so that you can see it together rather than the two separate slides. And here we have our first period of trading. And you remember we saw that we had on the debit side, anytime the expense is paid, and any accrued expense at the end of the period, which is called carried down or our closing figures. And on the credit side, we would have the prepaid expense carried down, which does not belong in that period, and your expense incurred, which is transferred to the income statement at the end of the period. So these four items is what you saw for the first period, which was the first period of trading. And then we come to our second period, and we just for now going to use another account. So we open the same rent account for the other period just to show how the different periods it's affected. And as we said, the prepaid expense at the end of the first period is brought across to the current period on the debit side as it is an asset. So you would see here carried down or carried forward, brought down or brought forward to the current period. And the same thing will go for the accrued expense. So you see the prepaid expense on the debit side because it's an asset. The accrued expense transferred over to the next period, but it is a liability. So it will start off the period as a liability, credit side. So for the current period, this is how you would begin your expense account. Because it's the second period of trading, the reason why we did not have these figures in the first period is because it was our first period. So there were no balances from a previous period. You now start business. But for your other periods after your first period of trading, you're going to have these two balances to start off with. And then during the period, you're going to just continue like with the first period. Anytime you pay the expense, in this case is rent, every time you pay rent by cash or check, you would record it in the rent expense account on the debit side. And at the end of the period, if there is any accrued expense, you're going to record it on the debit side and be very specific. It is your closing figure or your carried down, carried forward figure on the debit side. And then on the credit side, just like with the first period, if there are any prepaid expenses at the end of the period, you're going to have it on the credit side because you have to less it. So it's going to be over on this side and it's the closing figure or the ending figure. So it will be carried down or carried forward to the next period because all the figures at the end of a period would be carried to the next period either as the asset or the liability. Good, that is what we saw here. So we have this, and then there's one more figure which would be the expense incurred, which would be transferred out into the income statement for our period 2 to calculate our net profit for period 2. So this is just showing like these signify two different periods. Current period, this one here with the 3 items on the debit side and the 3 items on the credit side is the expense account that you are going to learn. Because the only reason this one did not have all is because it was the first time, but you only have a one first period, and then all the other periods you're going to have your balances brought down, your expense paid and your incurred, and then your carried down figures. So this is your opening and these are your closing figures. So how do we remember this format? Well, we are going to give you a suggestion. Our little burger character is something that we have for you to remember the format for your expense accounts when it comes to accruals and prepayments. And what we have come up with is PAAP. And for this lesson, for the first time, I'm actually making it into a burger. And we will call this our PAAP expense burger. And I will show you why I have it as a burger. But what you will see here is PAAP, P-A-A-P. And P represents prepaid, A represents accrued. And the reason why there are 2 P's and 2 A's would be because there is a prepaid at the beginning and a prepaid at the end. Or there's a possibility of it. It doesn't always occur that way, but you can have a prepaid amount at the beginning of a period, and then you can also have a prepaid amount at the end of a period. And the same thing goes for your accrued. You can have an opening or a beginning accrued amount and an ending or closing accrued amount. So you have PAAP, PAAP, and that represents the buns in our burger. So you would have the top bun, PA. You would have a top bun of PA, prepaid and accrued, and that would represent this here, the prepaid and accrued here. So P and A, and you see that on top there. And then your next two, A and P, would be your bottom bun, which would be this and this. So you would have your A and your P. So P, A, A, P. And it doesn't matter which way you take it, P, A, A, P or P, A, A, P, but it's always PAAP. So it will always be your PAAP burger or your PAAP. And the PA on top would be your brought down or your opening figures. And the AP at the bottom will be your carry down figures, right? So P, prepaid brought down, A, accrued brought down, A, accrued carry down, P, prepaid carry down. Notice you'd never have two P's or two A's, right? They're always like this. PAAP, P-A-A-P. Now a burger is not just made up of the bread. It has stuff in the middle of it. It has your meat and your cheese. In our case, we don't have any tomato and cucumber and bacon and all those kind of things, but you get the point. There's always something to make the burger, whether it be the beef or the chicken or whatever it is. So that is the same thing with our PAAP burger. Yes, you have your PAAP as in the bread, but what goes in the middle of it? On this side you would have your cash and bank, and on this side you will have your income statement. This is our format. And in terms of our burger, there is our PAAP burger with the PA beginning figures, AP ending figures, and then you have in the middle there, you have your cash and bank and income statement. So this half of your burger, you have PA with your cash and bank in the middle, and AP with your income statement or transfer to income statement in the middle. And this is your format for an expense account. You can just remember it. I know you guys like food, so think of this as the most delicious burger. It is very important as an expense account burger. PAAP with your PA, AP, and then your cash and bank, cash or bank, and income statement in the middle. And this is the format for your expense account for a period. It's a way for you to remember it. If you have another way that you can remember it and you want to remember it, feel free. PAAP, remember that word, not crap. Don't do crap, do PAAP. Good? So here we have our format for the expense account. So we just want to emphasize that this is the format, and something that you would note, just note it. Yes, there's the PAAP, but please note that even though in our explanation I had opened two accounts to represent the two different periods, in reality it is one expense account, and that one expense account would show all of your different periods. So you see in this example you have 1, 2, and you have 3 periods. And these 3 periods, the middle one, the blue one, is the current period. This one would represent the first period. Notice no balances at the beginning. So this is our period 1. And the reason why we call it carry down is because the next period is right below it. So you don't open a separate account for it and go across like we had seen. That was just to demonstrate the different periods. You actually have it in the same account and you carry it down, bring it down, carry down, bring down. So you just keep on going down until you run out of space. Only then you will open a new account and then continue again. So that is the emphasis, that even though in the explanation that was just for visuals to just explain the different periods and stuff like that. So we had the two accounts representing the two different periods, but in reality it is one account, and you just have the different periods below each other. So this is your format that you will learn, even though it has your 3 periods. The main thing that you're going to be looking at, the PAAP, this is an example of it. Your current period will have your PAAP with your bank and cash and your income statement in the middle, right? So this is the current period. This period was your first period. This period is your current period. And we tend to like to bring down the figures one time into the next period. So this is just the beginning of your next period. We haven't done anything yet for the other period. So this is the format that you are going to learn using PAAP, with the first P and A being your opening figures or your brought down figures, and the second A and P being your closing figures or your carried down figures. So just going to go into a little explanation in terms of your opening and your closing figures for a period, just to make it a little clearer for you, because some people have a little problem with this part of it. Remember, the accruals and prepayments are recorded as the brought down and carried down figures in the expense and revenue accounts. So this is why we would have our PAAP, where you would have your opening and your closing. Your opening figures are usually represented by brought down, and your closing figures are usually represented by carried down. I like to remember it like that: B, beginning, brought down; C, closing or ending, carried down, right? And you just always remember your beginning or your opening figures would be the amounts at the beginning of a period, and your closing would be the amounts at the end of the period, whether it is a month or a year. So this is what we're going to go into a little bit, the opening and the closing in terms of your dates. It's very easy when it comes to like a calendar year. And in this case, in our example, the year is 2020, calendar meaning it starts from January to December. You would come across some examples where the accounting period is not the same as a calendar period. So it may start like, say, the 1st of September. If it starts on the 1st of September, say for example 2019, when would that year end? It will end on the 31st of August the following year, which is 2020. So you see that there would be some differences. So you're going to have to learn how to work out beginning periods and ending periods if they don't do it as simply as a calendar year, which is January to December. Right? If they do it, if the accounting period starts somewhere in between the year, that means it's going to end in the middle or somewhere in between in the following year. 1st of September to 31st of August for the following year. But in this case, we have it really nice and easy. It's a calendar year of 2020, which means that it starts on the 1st of January 2020. And it ends on the 31st of December 2020. Really nice and easy in terms of that. Now, sometimes the period could be in a month. And in our example, we're going to use the month of January. Once again, very easy, right? In terms of when is the beginning date for January? It's the 1st of January. Very, very easy. So your opening balances would be the balances for the 1st of January 2020. And your closing balances would be the balances for the 31st of January, the end of the month of January. Nice, easy. Very, very easy. Now, it's something to note. Remember, your closing balances become your opening balances for the following period. In this case, the following period would be February. And where did we get our opening balance for January? It would have been from the previous period, which would have been in 2019. It would have been the last date in 2019, which would have been the 31st of December. So your closing balances, this is what we are emphasizing, your closing balances become your opening balances for the following period. So your closing balance on the 31st of December 2019 became your opening balance for the 1st of January 2020. And your closing balance for January 2020 will become your opening balance for the 1st of February 2020. So closing balances become opening balances. Closing balances become opening balances. See, I hope you guys are understanding. So for January, they would have gotten their balance from December, and they would pass on their ending balance to February the following month. And then February will pass on to March, and so on, and so on, and so on. Okay? So the best way that we can emphasize or reinforce would be by doing an example. Very, very quickly. But before we go into the amounts and stuff, we're just going to show it in terms of the format without any figures. And remember, for the expense account, it's our PAAP burger. So PAAP, what do you start with? So we're going to be doing January 2020. So you start with the year. Which year we doing? 2020. And for PAAP, we're starting with the beginning figures. And what is the first date or the beginning date for January? 1st of January. Simple. And in our PAAP, prepaid expense. So it will be prepaid, and you don't have to put the expense because you would actually have the name of the expense here. So if it's rent, you would have rent account, and this will automatically be known to be prepaid rent. So to save space, you can just put prepaid brought down, right? P, prepaid brought down. So you have your prepaid brought down, and you put it on the debit side for your PAAP, and you just put the amount. So far, we're just representing it as an X. Okay, so next one in our PAAP would be the accrued brought down. Beginning date, January 1st, accrued brought down, and you would just put in the figure, whatever the figure is for January 1st, because we're doing the month of January, right? And then if we're doing it as our PAAP, our ending date or our closing date, so we reach A, we already did P and A, and the first two are our beginning figures. Now we're going to A, and it's our ending or closing figure. So it will be the closing date in the month of January, which would be January 31st. Accrued, and since it's our closing figure, it will be carried down, and you put the amount for that date if there are any accrued expenses, right? And then to end it would be our last P in our PAAP. So we would have January 31st, prepaid carry down, and you put the amount that goes with it. We're remembering our burger. What's in between? You have cash or bank. Whatever date any payment is made for that expense, you're going to put the date, and you're going to put whether it's cash or bank. If it was paid by cash, it would be cash. If it was paid by check, it would be bank. Okay, simple as that. And then our last one would be the income statement. The amount incurred or the expense incurred is always transferred to the income statement at the end of a period. And since we are doing for January, it will be transferred on the 31st of January. Income statement, and you just put the amount. Okay? Now that amount is usually, we have to work it or calculate it afterwards, and I will show you how you do that. But you basically will total the two sides. If you have a missing figure, you go to the side that has the greater amount, and it's usually this side, and you just add them up and you will end up with a total, and your totals must be the same, and this will therefore be the missing figure. Oh, and there you have your PAAP, PAAP, with your cash and bank and income statement in the middle there. But for extra marks, what we usually do, we don't just leave it like this. Meaning you basically you've done your PAAP, but for the extra, we usually go and we bring down our figures one time. So you know, like how it says to carry down, we usually carry it down one time. And it is to be noted that if your carried down figures are on the debit side, your brought down figures will end up on the opposite side, which would be the credit side. So if your carry down figure is on the credit side, it will go on the opposite side. So your accrued carry down will be brought down on this side, and your prepaid carry down on this side would be brought down on the opposite side. Now I just want you to note PA. So you see it ends up on the relevant side for the PAAP. And this is basically what all of your expense accounts are going to look like. They're going to look like PAAP, not crap. They're going to look like PAAP, right? PAAP with the meat and stuff in the middle of it. So this is what you have to learn. This will be the extra after you have done this part, but this is what you're going to focus on getting. Your PAAP, your wonderful delicious burger here, and that is what you're going to learn to do with this example. Okay, so we have our example here, which would be our expense is a utility expense, and like with any other format, you start with the name of the business and the name of the expense account, which in this case is utility expense, and you do your T account with your debit and credit side, date details, folio debits, date details, folio credit. And you would see from our example over on this side that we have our two balances, our opening balance, which would be the beginning date, 1st of January 2019, and our closing balance, which would be balances, I should say, the date would be the 31st of January 2019. So we are doing it for the period of the January 2019, 1 month. That is basically it. You see it up there, right? Cool. So remember our little way of remembering, since it's an expense account, we're going to use our PAAP. And that's our suggestion. We're going to use PAAP, PAAP, P for prepaid, A for accrued, remembering that the first P and A would be our opening balances, and the second A and P would be our closing balances. So now we can go and start with the year. We're doing it for 2019, so you would always start with the year 2019. And we're going to deal with our opening figures first, which would, the date would be the 1st of January 2019. That would always be our date for our opening for this question, because we're doing it for January. So 1st of January, and since we're going with PAAP, it will be prepaid brought down, or the opening figure for prepaid. So you're going to check your, and you would see right here that there is a prepaid utility expense. you simply just put it into the account, debit side, that's it. So the second one, the PA, accrued, brought down. Check your question. Do you have an accrued at the opening date? Yes, you do, $50. Put it in. That's it. Easy. Really, really nice and easy. So going back to our little pap burger there, we just dealt with the top of the bun, the top of the burger, which is the P and the A, these two opening figures. Now you can either go to the other two, or you can just go in the order. We are just going to go in the order. So it's PA, and then we're going to go to the middle part, which would be our cash and bank here. So that goes in between here, and you're going to look to see, did we pay any utilities? And you would see down here, yes, we did on the 20th of January, and the amount was 900. So you're going to come to your account and you're putting the date that it was paid, which is the 20th. Bank or cash. If they tell you that it was check, it would be bank. If they tell you it was cash, it would be cash. If they don't tell you anything, we usually put bank. So bank or cash, and the amount 900. As easy as that. So you would see from our burger, the next thing in between here would be your income statement, and the amount transferred to your income statement is always done at the end of the period. So that will be the 31st of January. You don't have to put the whole transfer to income statement, and it's understood that you're sending it there or transferring it there. Do you see any utilities incurred? Because that is the amount that is to be transferred. They did not give us that figure, so that means that we now have to calculate. So we're going to leave that there for the time being and go and enter the other figures that would have been given. So we already dealt with the first PA, which would be your opening balances. Here we dealt with that. We dealt with the in between, except we don't have the figure for income statement. So the next step is to continue with our PAAP. We already dealt with the PA, so it now be AP. So these are our closing figures. So we're just moving on to our closing figures now. And the 31st of January. And since it's PAA, we will have the accrued carry down. You look at your closing figures. Is there any accrued? Yes, there is 100. So you put it on the debit side. And you have PAA and the last P, 31st of January, prepaid, carry down. Is there any? Yes, 300. You put your 300 there, and you have just finished your PAAP with your meet in between, with your cash and bank and your income statement, except for the fact that we are still missing the income statement figure. How do we calculate that? So this is the process. First thing you do, you're going to total. So you draw your two totals. Notice that the boxes are, or the total columns are side by side. It must be in the same line. You look at the side that has the greater total. So when you add it up, which one would have the most? And that will be your debit. So you add the 200 plus the 900 plus the 100, and that will give you 1200. So this is your total here. When you add these up, this total must be the same. So you would just bring the 1200 over on this side. But this side is not equal to 1200 as yet. You still have a missing figure. So you just have to find what figure would create that total of 1200. How do you do that? It's the total minus these two figures here. So it will be the 1200 minus the 300 and the 50. And that will give you a total of 850. as the expense incurred, the utility expense incurred that is to be transferred into the income statement. Okay, so this is done, and then we have our prepaid brought down. So you don't just finish it today, you're going to have to bring it down. We like to bring it down, we don't just finish it. And you will notice that whatever is on the credit side is brought down on the debit side, and vice versa. You will have the accrued would be brought across to the credit side. Notice it's the same figure, and then notice the dates as well. Remember what we said? The ending figures will always end up as the beginning figures for the next period. So that is what we're going to do, and oh, I got a little bite there. And that's the end of your expense account. Easy like PAAP. Yeah? Easy like PAAP. So once again, we had done for the month, which was January. This example we can do now for the year. So we can actually try and look at the year now and see if we can. Now it's very easy for a calendar year. So this calendar year is 2019. The beginning date will be the 1st of January, and the closing date would be the 31st of December. Very nice, very simple. So you're kind of wondering why we're going to bother and do this. We're still going to bother and do it, right? So we can have our example here. Look at this. Look at our two dates. There is no 1st of January 2019. Instead, we have two closing dates, which would be the 31st of December 2018 and the 31st of December 2019. So where would we find our closing date? Where would we find our opening date? Because our opening date is supposed to be the 1st of January 2019. Now, I think some of you would already know where we're going with this in terms of the finding which date it is. I think you guys know which one it is, but let's just see. So, which date would be the opening figures in our two dates there? Basically, remember, it will have to be the closing date for the previous period. That is where we get our opening balances. If you remember, we would have said how the ending or the closing is your carry down, and it's carried to the following period. Yeah, so basically the closing balance on the 31st of December 2018, that is the date or the balances of that date that become your opening balances for the 1st of January 2019. So therefore, you start the current year with the same balance you ended the previous year with. Yes? So I think that is clear for everybody. If you are given two closing dates, the older year or the previous year, that balance or those balances become your opening balances for the current period. So they gave us two closing dates. This is the older year or the previous year. 2018 is before 2019. So these balances automatically become your opening balances for the 1st of January 2019. So now we can move on. We have our opening balances. And we have our closing balances, and because it's an expense account, we are using PAP, 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 PAP. And which year are we doing it for? Our current year is 2019, so you're going to put your 2019, always start with the year. And the beginning date, you're not going to put 31st of December, because remember, your opening balances must always be a beginning date, the beginning of the period. And for 2019 calendar year, which is the date that starts off the year, 1st of January. So it's going to be 1st of January. So we're dealing with our opening figures, and the date is the 1st of January. And since we're using PAP, it will be prepaid brought down. You're going to look to see, is there any? Yes, 700. Put the 700. Move on to the A. 1st of January, opening balance for accrued. The A, accrued brought down. You look under your opening balances. 250. Put 250. Move on. You have the in between or the meaty part, which would be your cash or bank. You're going to look and see, is there any cash in bank? Rent paid for 2019, 3,600. Now, they did not give a specific date in terms of the payment. So whenever they don't give you a specific date, you just put the end of the period. So the end of the period is the 31st of December 2019. So you would just use that date in the absence of a specific date for any payments. And how much it is? 3,600. Good. Next part of your meat, on the middle part, 31st of December, because you always transfer to income statement at the end of the period. So you will put that there. Don't have the amount incurred. You don't have the rent incurred. It's the rent expense that we are doing now. So you're going to leave that, and you're going to put in the other figures that you have, and then we'll come back and work that out. So we are now on to the closing figures, which would be the 31st of December 2019. So you did your P and your A, so PA, and now you go on to the next A and P. So it's A, accrued, but your closing or your carry down figure, you check to see it's 300 and you put it there. And then you have 31st of December, your last P, prepaid carry down. You check to see, yes, 800. You put it in the column there. And then you just move on to now work out what your income statement amount is. And you will have it as your total. You check which side has the greater total, which would be your debit side. 4,600. The other total must be the same, so you put 4,600. And to find your missing figure here, it will be 4,600 minus your 800 and your 250, which would give you 3,550 as the rent expense incurred for the 2019, for the period 2019 ended on the 31st of December, to be transferred to your income statement. Are we finished? Hey, well, we finished the first part, we finished the PAP part of it, but we know that we like to still bring down our balances for the next period. Now, we are dealing with a year, not a month. What is the day that comes after the 31st of December 2019? So just think of all years, and you're on the 31st of December 2019. What are you looking forward to when that clock strikes midnight and it's 12:01? It becomes New Year's, which would be 2020. So your beginning date for the next period would be 2020, 1st of January. So, seeing it there? Let's see. Yeah, there. let's see, there we go. 1st of January 2020, and you bring down your balance from the opposite side. You saw it there, and your prepaid brought it down back on your debit side because it's an asset. 800 is always the same amount, and just like you brought it down from across there, you're going to have to carry this down and bring it down to over there. 2020, 1st of January, accrued brought down 300. Now you are finished. So we do the expense account and then we do the revenue account because they kind of go hand in hand. Just remember something, they're the opposites of each other, but we're still going to go through quicker because the same things apply in terms of like opening balances and the dates and stuff like that. What changes would be, it would not be PAAP because the order would change because they are not the same account, and expense is one thing and revenue is the next. Remember that for a period, revenue accounts would record the revenue earned and received in a particular period. The increases in the revenue would be recorded on the credit side, which is the opposite of the expense account, right? And the decreases will be on the debit side. So they switch. As simple as that. They switch. So that means that the format, the expense account was PAAP for a period. The revenue account, because it switches, it will become what we refer to as APPA. So that means our burger switches sides and we will end up with APPA. But the entire burger switches. So that means this side of it also switches. These two things will switch as well. It's the entire half of the burger. If you notice, see, our burger was like this, and then we just broke it apart, and you had your two sides, and you flipped it over. So that means that your cash and bank will also go on this side, and your income statement will go on the debit side instead. So this is our format for the revenue account. You would have your A for accrued revenue, and it will be your beginning figure. Your P for prepaid revenue, beginning figure. Your P for the carry down figure would be on the debit side, and the accrued revenue would be on the credit side, right? And then you will have your wonderful meat in between, which would be income statement on the debit side, transfer to income statement, and the cash out bank on the credit side. That's because with revenue, whenever you increase revenue, remember it's the opposite of the expense. Whenever you increase your revenue, it goes on the credit side, and whenever you decrease your revenue, it goes on the debit side. So the same explanation in terms of why we increase and decrease and all that sort of thing, as in, like, for example, prepaid revenue is unearned, so it does not belong in this period, therefore you have to take it away. And accrued revenue, it does belong in this period, so therefore it will be on this side. Yeah, so our format, taking a look, it will be good to note that once you know your format for expense, you know your format for revenue. Just flip the sides and you're good, right? This is why we learn off the expense so well. So it's APPA because it's switched, and the revenue account, there we have APPA, accrued, brought down, prepaid, accrued, with your beginning figures being the top and your carry down figures being the bottom. And just like with the expense, you have the two in the middle, but unlike expense where cash and bank was on this side, any cash received goes on the credit side because revenue is increased by crediting. And then we have our last figure, which would be any revenue earned will go on the debit side to be transferred to your income statement at the end of the period to calculate your profit. And then you will do the same thing where you total, and you have to have your totals equal. And the last thing that you can do would be to bring down your figures to the next period. Always remember, if your carry down is on one side, it's brought down opposite side. And this would be your APPA, APPA, with cash and bank on this side and income statement on that side. Of course, one revenue account for all the periods, just like with the expense, but instead of the revenue account being PAAP, remember we switched it, and therefore it is APPA. So the way to reinforce this would be, of course, through an example, and we're going to use very, very simple dates. We're going to do it for the month of January, right? So not difficult at all. Like all formats, you start with the name of the business. The name of the revenue is rent revenue in this case, and you have your account there, your T account, and we will start with our opening figures, remembering that we are not using PAAP, we are using APPA because of the total switch that we had, because expenses and revenue are the opposites of each other, right? So which year are we doing it for? We are doing it for 2019, and it's the month of January 2019. So the beginning date will be the 1st of January. So you're going to put 1st of January, and since we're doing APPA instead of PAAP, start with the accrued first, opening balance for the accrued. You check to see there's $250, record it, debit side. Move on to P, same 1st of January because we're dealing with the opening balances, and it's the P prepaid brought down or opening balance. You check to see 600. And then we have our prepaid rent revenue, and we have our accrued rent revenue. Beginning figures haven't been recorded. So we move on, and we're going to go to the middle part, which would be your cash or bank. And notice once again, since this is your revenue account, it is not on the debit side, it is on the credit side. Everything totally switches. So everything that was on the debit side for the expense account goes over to the credit side for the revenue account, and everything that was on the credit side for the expense comes over to the debit side for the revenue. Total switch, right? So bank and cash is on the credit side because whenever you receive revenue, that is an increase, and increases in revenue are recorded on the credit side. That is why it's over on this side, right? So we look to see, we see that we would have received rent on January 25th, and how much it was, $2,000. So you're going to put your date, January 25th, and the amount is going to be the $2,000, and that's it. Okay, so what goes on this side for the revenue? It will be your income statement or transfer to income statement. It is always done at the end of the period, so that will be 31st of January. Did they give you the revenue earned? No, they did not give you that figure, so we are going to have to calculate it. So we're going to leave that there and go and record all of the figures they did give to us, right? So we have dealt with the AP part of it, the first two, which would be your opening figures, and we've dealt with the middle figures, which will switch from the expense account. So if you remember the expense, you just switch for the revenue, and therefore we are going to move on to the second P and A, the PAAP part of it, which would be your closing balances. Closing date would be the 31st of January. And since you're dealing with the P, it's the closing prepaid or the prepaid carried down that we are going to be dealing with. And yes, we have it there as 500 prepaid rent revenue. And your prepaid rent revenue, 500, record it debit side, and you deal now with the final A, which is your closing on the 31st of January, accrued, carried down, no closing figure, and how much it is, 350. So you just record it there. And you have your APPA done, except for the fact that you do not have your income statement revenue earned amount. So we remember how you're going to calculate. Do the same thing as we do for the expense account and for all accounts when you are balancing at the end of a period. You're going to total. Which side has the greater sum total? In this case, it will be the credit side. So you would add 600, 2,000, and 350, and you will get a total of $2,950. So then you're going to go across now, and you're going to put the same total, because these totals must be equal. So 2,950. But this side does not equal the 2,950. You have a missing figure here. So to find this figure, it will be 2,950 minus the 500 and the 250. And that will give you 2,200. So now you have totally completed your APPA burger, and the only thing left is that nice little extra that shows how smart you are and how you know your work. We usually like to end with bringing down the balances. So they said you have to carry it down. So you carry it down and you bring it down, and it's always the opposite side. So your prepaid carry down will become your brought down on this side, and your accrued carry down will become your brought down on the next side. What is the next date? So if you end on the 31st of January, the next date will be the beginning of February, the following month. So you would have 1st of February, and you just brought down your accrued, and it's the same amount. Whatever the amount is carried down is the amount that is brought down. Okay? And now we have over on this side your closing balance. So your closing prepaid goes across on this side, and it's the same 500. Just a note, accrued revenue, if you remember, is a current asset. As an asset, assets are usually debited. Look at where we have our accrued revenue. It is on the debit side. And then if we look at our prepaid amount, prepaid revenue or unearned revenue is a current liability. It's unearned, so you owe, right? So it's a liability, and liabilities, according to double entry rules, credit. And look at here, we are on the credit side. So even though they are not in their asset and liability accounts, they are still on the correct sides in the revenue account. Isn't that cool? Yeah, it's very cool. So that's it for our lesson today. We learned about the expenses and the revenue accounts in terms of the accruals and the prepayments. For CSEC, since we do not open the asset and liability accounts, we use the expense and revenue accounts and the opening balances and the closing balances to record our accruals and prepayments. And as we saw, it still ends up on the correct sides in terms of the debits for the assets and the credit for the liabilities. So that is pretty cool. We have suggested a way that you would remember the format, and that is PAAP for the expenses, and you just switch it for the revenue and it becomes APPA. So PAAP, and we use the ridiculous burger to signify that between the two, the PAAP, there is the cash and bank and the income statement, and the same thing for the revenue. For the APPA, there is still the cash and bank and the income statement. Right, so just remember that. And the best way to actually get it into your long-term memory would be to practice. So don't just memorize the PAAP and dream about the burger and eating the burger and all that sort of thing. You have to now apply it, and apply it over and over and over again by doing the activities and stuff. And then it will go into your long term, it becomes easy, and you're good to go. Okay, so that is it for our lesson today. Enjoy till next lesson.